Kia ora everybody, and welcome to our webinar on having the right retirement mindset. My name is Nadine Higgins, and we've got a lot to talk about tonight, and I'm going to introduce you to our panel in just a moment. But first, to kind of set the scene, retirement's a funny one because when it's a long way away, we're kind of like too hard basket, more immediate priorities, I'll deal with that later. And then all of a sudden, it's not that far away. It might be 10 years, maybe it's 15 years, or maybe it's 5 years and you're really starting to feel a little bit nervous. But then there's also actually getting into retirement, where you've spent all this time building up your assets, building up your savings, but then you have to get used to the idea that there's no more money coming in anymore. There's only going to be money going out, and the size of your asset base diminishing. So that can be stressful. Maybe you spend not enough or too little because you're worried about running out, but instead what you run out of is joy in your life because you're not spending any money. And then on the reverse of that, you could be like, it's fine, go hard. And then the end of your life could be not very much fun because you've spent everything that you've got. So we're going to answer hopefully some of your questions tonight. You're welcome to contribute more anytime they occur to you. I'd just ask you to put them in the Q&A box at the bottom of the screen so that I can keep track of what has been answered and what still needs to be answered. But you've sent some great questions in as part of your registration process, so we'll have plenty to chew on over the course of the night. Before I go any further though, I do need to say that this is informational only. We're going to aim for it to be really useful information, but we can't give you financial advice. We'd love to give you financial advice, but we need to meet you and understand you and everything you are and you're not, and you want and you don't want, in order to be able to give you something that is useful and fit for purpose. So we'll tell you how you can find us at the end, but for the meantime, I hope this information is useful. So let's now introduce our panel. And first up we have, I call her a force of nature, a financial force of nature, Hannah McQueen. She is the founder of Enable Me and our managing director. So she's a financial advisor, she's a chartered accountant, she's the author of 3 best-selling personal finance books, and of course she started the company. Welcome, Hannah.
I'm excited to be here. Thank you.
And also joining us is Nikki Morsink. Nikki is the head of Enable Me Investments. You might notice a slight rounding to her R's. She hails from Southland, and she has an extensive history in investing, including being the VP of Morgan Stanley Institutional Equities. Is that right, Nikki? Yes, in London. So these two are the perfect people, leaders in their field, to be talking to us about retirement mindset and preparing for retirement. So if that's what you're looking for, you are in the right place. So let's get into it. I thought I might start. This is a really good question, I think, about the mindset angle of navigating retirement. I think I've got enough for retirement, but I'm scared about just watching my money be eaten away. But I'm also worried about investing it more aggressively in case I lose it. So how do I navigate that shift for my sanity? Hannah, what do you think? What would you offer this person?
Well, there's 2 components around that. We need to give you permission to spend your money as you want to live the lifestyle that you want to live. Because I think the true definition of a good retirement is to be able to live as you want for as long as possible. And normally we want to live to a lifestyle we are accustomed to. So what we've done previously tends to be what we want to do. So the first component is, how do we make sure that your money is going to stretch far enough for you to be able to enjoy it on a day-to-day basis now? And then there's another question, which is, how do we invest that money so we're not taking on any more risk than what your situation needs to achieve the retirement you want? And the answer to that question is because they're 2 completely different scenarios, but it's almost, in Excel, you can have a circular reference because they feed off, they're 2 separate scenarios, but they feed off each other. And if you haven't got the first one right, understand what you need for your lifestyle, it's almost impossible to determine what is the risk we need to take, expose you to, in order to give you the growth you need so that your money lasts. And I think one of the problems with a lot of wealth products is they ask you the risk that you're happy to stomach, which is different than the risk that you need to take, right? So they're slightly different. And so you can be influencing an outcome when you don't even know what you need to do to get that outcome. So we want to address each one individually, but they come together into a plan. And unless you understand that for you, which will be different to me or different for Nikki, unless you understand what that means for you, it will be really difficult to feel safe and enjoy your spending.
That was such an accountant analogy, the circular equation in Excel, but we understand what you were getting at. Nikki, what do you think about this transition into retirement and getting your head around your money actually diminishing rather than being replenished every fortnight or every month?
Yeah, that's a good one. I mean, certainly it's a mindset shift for sure. But what I would urge people to remember is that sure, you might be retiring and you won't have the salary coming in necessarily, or you know, if you own your own business, the drawings. But effectively, that money should still be working, right? So it sort of feeds this feeling that you get to retirement point and everything you've got goes into cash and it sits in the bank, and then it's the last thing you should be doing, right? Because that money needs to earn its keep, and it needs to keep you in the lifestyle to which you would like to become accustomed, really. So it's got to keep working. And so you just, going back to what Hannah just said, is that can be done quite effectively with the right strategy that meets your criteria, and with just the right level of risk. When really what we're talking about there is, you know, exposure, like whether it's growth exposure or capital gain exposure. To me, if all of that's done by starting with the end in mind, you know, so you think about your situation first, you do the planning. That's where the safety sits.
So we start with the end and we work backwards. Based on what you were saying, there's another good question here that sort of feeds into that when you're using your retirement money, are we best to use the money in the bank before managed funds money when it comes to time to use it? Currently, the bank money is earning less than the managed funds, which is not a surprise, is it?
Actually, I think not necessarily. So the bank is a really good place for your emergency buffer. And it's always good to have one, because that's just it's handy, and B, it's an insulation for whatever investments you've got rolling alongside it. So, you know, and again, how much that buffer is will be situational, you know, depending on your lifestyle and cost outgoings. So you want a cash buffer there. But I think managed funds, one of the best things about them is that you have them working, but you can have a regular deposit hitting your bank account, which feels a lot like the salary did, to be honest, you know. So that's drip feeding into the account, and that's, you know, that's done in your price averaging out, like it's just a nice even flow, and the money's still working in the background. So no, I wouldn't park large sums of money in the bank, or, you know, to use first.
And it's slightly different than when you're trying to grow wealth, right? And I think that's one of the things we're trying to call out tonight, that some of the principles for wealth creation are different when you are eating into your wealth. So it's quite normal to think, if you're trying to grow wealth, you wouldn't leave your money in the bank. You would put that to work rather than just drawing from it. But when you're considering retirement, we're actually trying to say, well, we always want you to have an emergency fund, a cash buffer, because that de-risks the performance of your investments. So the role of cash is different as we transition through to retirement than what it was before, because we would hate the money just to be sitting in the bank not doing anything normally. If we were coaching you, we'd be like, what do you mean that money's sitting there in a savings account? We could be putting that to work. It's a different focus when we are trying to position you at retirement.
There's a couple of questions here which I know comes up all of the time, but I think it's worth addressing for those who aren't yet retired. How much money does a couple really need to retire nowadays? This person says, I've heard it needs to be about $1 million, or is that per person? And then someone else saying, I've got no mortgage. what amount does a retired couple require for a quiet, normal life in Auckland? So how much do I need is the basic question.
Well, it's hard when you're saying a quiet, normal life in Auckland. I mean, what the heck does that even mean? That feels like an oxymoron. Well, there are some basic principles that will help you understand it. And I think one of the reasons why it's hard for people to know their number is it feels so opaque as to what that number should be. Because we all know someone, my dad included, who's able to live off the pension without capital that he's eaten into. He can actually, because he's mortgage free, because he's got a financially independent child, and he's got a big vegetable garden and very low living requirements, he can live quite comfortably. But when I do my retirement planning, I think I need about $5 million on the bank on a good day just to live the lifestyle to which I'm accustomed. So the first question we need to ask is, well, if you want to live the lifestyle to which you are accustomed, what does that cost? Because it's what you're doing now. And assume you don't have a mortgage, because let's assume you're going to be mortgage free by retirement. Whatever that amount is, you times that by 25 years, because that's how much your life's going to cost over that 25 between 65 to 90. And then we say, look, we do have a superannuation that normally pays around $500,000 per person against what that retirement number is. So if your lifestyle costs $100,000 a year, which is the average Enable Me lifestyle, just as a reference point, if it costs $100,000 a year, excluding your mortgage, then if we need to fund that for 25 years, we need 2.5 million as a starting point. Then we take off, well, we're going to get some money from the government as a pension. So that's $500,000 per person. So that's going to take it down from 2.5 to 1.5 million. That's the number, the average number that Enable Me customers need to be able to live the lifestyle to which they are accustomed. But that lifestyle cost ranges from $50,000 to $500,000, depending on the customer or the client. But then we know, well, this is what you need for retirement. Let's now compare it with what you are on track to have, because the real question is, what is the gap between those two things is where your wealth strategy needs to come in. But I would say for most couples, if you're being conservative, between 1 to 1.5 million seems to be the average amount that an Enable Me customer would require as a starting point, which we want to reduce that if we can, but that's where it starts.
And I mean, it sounds like a big number if you needed to have it to magic it up tomorrow. But if you've got some time, then you've got options for how you can generate that, bridge that gap, right?
Yes, you do. And not only if it's 1.5 million to start, we get to work trying to reduce that gap and then get your money working harder as well. So one of the people wonder why we pay so much attention to your cash flow or your budgeting, your ability to save, because that has a disproportionate impact on those numbers. If we are able to save $10,000 a year, which is a few coffees a week, expensive coffees, but you get my gist. It's kind of quite an insignificant amount, but that changes your retirement number by $250,000, right? So the impact of saving or not saving determines how much you're going to be able to grow before retirement, and also the pace at which you're eating into it in retirement.
Here's a good question for you, Nikki. I have been retired for a year now and loving it, which is great to hear. We want your retirement to be something that you actually enjoy. I've got savings with a managed fund, but the stocks, shares, bonds market is dreadful at the moment, giving a poor return. My question is, what would be an alternative investment with a higher yield, or should I ride it out?
Good question. So actually, since probably, I don't know, sort of end of May, beginning of June, that should have picked up a wee bit for you, I'm hoping. So, markets are improving. Absolutely. I think that you should, knowing as little as I do, but my natural response would be to ride this out. It would be good, as long, and I'm sort of assuming, right, that you've got the right sort of portfolio and asset allocation for your situation. But assuming that's correct, absolutely write it out, because volatility, it comes and it goes, but it's time in the markets that creates wealth, and that basically involves doing exactly this, writing it out. And we all think we'll do it. We all think it'll be really easy when we go in with big hopes. And when it does happen, our natural human nature kicks in, and you start to think, oh, and maybe I should run to safety, which is usually the very last thing that you should do. So I would hope that if you checked the balance of that investment now, it's probably higher than when you wrote that question. And secondly, yeah, just as long as that risk profile's right for you, there's no reason that you should run to safety. It'll do its job. The tide goes in, the tide goes out, but it's the time served that will pay the benefit, right? And in retirement, so you're in early retirement, then you should have a good 20-25 years ahead, right? So assuming it's the right solution, I think stay the course.
Stay the course.
If I can just add to that, I think that the strategy that you set, and most people don't set a strategy for their investments. Most Kiwis don't. We seem to almost have an allergic reaction to doing some planning for this, despite it being one of your biggest financial milestones. But you are more confident staying the course when you understand the course you're taking and the reasons why, and the impact of changing. I think people, when they feel they can make an informed decision because they understand the opportunity something presents and the opportunity cost of doing or not doing it, you do understand. It takes the emotion away and you feel more confident. So we don't want you to waver in that strategy. It's important that strategy is revisited every year, and there are things that impact that strategy: your situation, market conditions, economic conditions. All these things change, could tilt your strategy in one direction. So you've got to be responding to that in real time. But that strategy is the single most important investment you'll make for your retirement, because you can stay the course even though there's headwinds, right?
Mm.
And what, just to add to that, sorry Nadine, is that what we're talking is planned. It's like advised investing. There's a big difference between advised investing and unadvised investing, and clearly, I'm biased, but the fact is, I mean, there is research-based evidence that supports this, and it's exactly for the reasons that Hannah just outlined, which is, first of all, whatever the strategy is should be reviewed every year in light of whatever economic winds are blowing, and secondly, really one of the big things that happens is it keeps our basic human reactions of fear or reaching for that last point of return in check, because that can be the undoing of us.
Who was it, Nikki? Was it the guy who wrote The Intelligent Investor? He said something like that the investors' biggest challenges themselves when we're talking about mindset. This is quite a specific question, but I think we can generalize it a little bit. They've got some ideas about what they should do, but they'd like your take. I own my own home, mortgage-free. I've got a couple of rental properties that will be mortgage-free by retirement. I'm widowed and currently at 58. If I was to sell one for $900,000, what would I do with the money?
Are you happy if I start that, Nikki? Well, firstly, I just want to do a shout out to your situation. I think that's a credit to you that you're in such a strong financial position. So I'm very pleased for you. So what you're looking at is, do we start to diversify our asset base? And if we do, to what extent and how? So there's kind of some bigger questions behind that. But if you were to withdraw that 900,000, cash transfer, cash in the investment property, get the cash, where do you invest it? That's when we'd be trying to align your remaining investment, so your investment property, with a managed fund strategy, so that between the two of them and your own situation and needs, you're creating a wealth plan that crosses between the two. Now, what we don't know is if you're still working or not, and if you need any of the cash from any of those investments. But that's when we're trying to determine, well, if we could design it, what are you wanting to do over the next 10, 20, 30 years? Because you've got enough base to actually blue sky a few ideas. And then how can we invest the money in response to that while trying to diversify as well? And I think it's the wealth plans, it's the integration of the investment property performance, yield and capital growth, combined with the managed fund performance, return in the short and medium term, that allow you or give you more flex, more options than most people would have. So that's kind of the magic dust that you don't want to just kind of shoo away. You really want to take hold of that, because that's going to de-risk. If you do this right, that will de-risk the next 40 years for you, which is incredible.
You're so right, Hannah. Worth a shout out, that one, but still some things to consider. Did you want to add to that, Nikki?
Well, I think it was an amazing explanation, actually, but the only thing I would add is that apart from the extra layer of diversification that mixing those assets would bring, so when Hannah talks about running a managed fund alongside a property, it also brings in that wonderful quality of liquidity. So at some point, maybe not yet because you're only 58, but at some point liquidity is going to become important, so that you're able to access cash when you want it while the rest of your asset base is still working.
Yeah, there's actually another question here that's very relevant to this, but retiring with property assets as a nest egg, but very little actual cash. What should I do? I guess that then becomes about the assets you might look to sell and when.
It is, and whether any of the assets you have are the right assets to keep for the next cycle. So the idea of having an investment property and a managed fund, and selling investment properties to give you more of a managed fund so you can get that liquidity, the concept of that we're all for, just generally. But then you come down to, you say, well, if I was to keep like 1 or 2 investment properties, which ones would they be? Are any of them the right properties for us to hold, or should we be looking to replace those as part of a bigger strategy? Because if your properties are not performing at the optimum level we would want for a property, what that means is that you're not able to take out as much cash on a day-to-day basis from that property. It's not performing from a cash perspective as well as it could, which doesn't make it bad. But the impact of not being able to take out cash from the property means we have to take out money from the managed funds. And there are times in a market cycle where you might not want to do that, and you're forced to do that because your other asset isn't optimized. So often when we're going into retirement, what we want from an investment property is very different than what we might have wanted from a property if we were trying to grow wealth. So the yield becomes more important in retirement than what it may be pre-retirement. The yield is the rent relative to the purchase price or the capital you've got invested. So we have a different focus. So the idea of selling a property makes sense, and diversifying for liquidity makes sense, but being strategic is about not forcing your hand to pull from those assets, that managed funds, when the market isn't doing well. And if you've got an investment property performing really well, you're reducing the pull you need from that managed fund. And that's where you can get cute, but that's also where you can not inadvertently erode the capital base that you've got.
It's a really good point, because while we talked earlier, Nikki, about time in the market versus trying to time the market, if you are forced to sell at a particular time, that can be to your disadvantage if you can't then lean on other assets to offset that impact, right?
Correct. In saying that, though, really easily avoided with even a modicum of planning at the beginning, so this is where because just because we're saying like the asset groups that we're leaning on to create wealth, the property and managed funds, but cash at bank still has a place, and that's very much as an insulation level to avoid that. So and you don't ever want to have too much sitting there, but you also want to have enough. But that number becomes, as you go through a planning and thinking it through process and a future sort of lifetime cash flow projection, you get quite a good feel for what that number should be. So I would suggest that, if you think about it too, downsides in markets, depending on how much growth exposure you've got, it might be one in every 3 to 6 years. So there's a lot of years where that's just not a problem. Like the markets are doing their thing, it's fine, and there's more of those, thankfully. But also with just a tiny bit of planning and having just the right amount of cash parked in the right place, you can go a long way to avoiding that.
This actually brings up a really good question that's come in this evening. Should owning a rental property be part of your retirement strategy in the current market conditions? So lots of people are asking this at the moment, Hannah, that they've seen that things were great for property investors historically, but will they continue to be?
Yeah, well, there's a few things to layer into answering that. So firstly, no one knows what property is going to do, the property value is going to do next week or next month or even in the next quarter. No one knows. But what we do know is over the medium term, we expect it to increase in value. If I'm being cynical, I would say if there was a drop in the property market, you can pretty much expect a similar drop in the share market. So as a comparable investment, it doesn't really, there is less risk attached to it. I guess coming back to, does property play a role? The answer to that is it depends. In a perfect world, and this is the kind of enable me perfect world, of the wealth that you've got invested, we would want, and the wealth is the assets, not including the home. We don't consider that part of your wealth portfolio. But of your wealth, we would want 50% to be tied up in investment property and 50% in managed funds. And we would want to have roughly, we'd have a portion of money in the bank most likely, and ideally access to revolving credit or a facility against your investment properties so that you're not backed into a corner with what you need to do with your managed funds if markets are dipping. But that would be kind of the perfect scenario. But the reality is not everyone has enough capital to purchase an investment property. So, and an investment property with a mortgage on it isn't giving you any cash flow. Normally you might have to top that up. So that might be completely inappropriate for you as you move into retirement. But if you have got an asset base that could afford you a property, what I like about property when partnered with managed funds is property is it's the least volatile of assets. So even though they might go up and down, the property still exists at the end of a cycle, and that gives me comfort. It also goes up and down. That volatility in between each year is the least volatility compared to even cash in the bank, the movement you might get there. So I love the role that property plays in a retirement plan, but it is different than when I'm trying to grow wealth through property. We've got a very different strategy. So what would be a good property pre-retirement might not be appropriate in retirement. And I also think when you come to retirement, we do this every year with our customers anyway, you have to review the properties that you've got because they are not necessarily, and I'd almost go so far as to say they are unlikely to be fit for purpose as you transition to the next phase and for the next cycle. So that refresher of the detail of what you've got becomes important as well.
There's a really interesting question here that I'll see if we could tackle. I'm an older first-time dad, and my 2 children will be in secondary school when I turn 65. My wife is currently not working, and we have a mortgage that won't be paid off before I turn 70. While I'm planning to work beyond 65 as a consequence, how differently should I be planning?
It's very differently and very quickly. This is the reality, the constraint of your situation, and we're going to have to be creative with how we do that. I mean, the obvious get out of jail free card for most situations, and possibly including your own, is that you can downsize your home at some point. But really, we've got to put that equity to work before then, so that we don't need to make such a dramatic kind of correction when you need, but the family situation might not permit, because there's an assumption when you downsize your home that your children have in fact left home. So if they haven't, then we're in a pickle straight away. But yeah, there's some future cash flow modeling is going to be really important to inform you of your choices and why you should be taking action sooner rather than later. Because for every year you defer getting your money or your equity working harder, you're not reducing the gap that you need to close. You're giving yourself less years to close it, which means if we still need to make up the same amount of ground in less time, you are almost forcing yourself to take on more risk than what we would otherwise prefer. And that is a problem, because it's all well and good us saying taking on risk to get a return. Your ability to stomach that risk normally is the thing that sees you exiting stage left before you even get the return that you intended. So yeah, there's a rub there, and we get onto it quickly.
We've got the questions coming in thick and fast now. Ross says, how to plan for retirement in high inflationary times. Currently, we have 7% inflation, 7.3 even, that far outweighs returns from managed funds and property. I'm 50 years old. What strategies do you recommend to address that? Nikki?
Thanks, Nadine. I'm not sure I quite agree with the question, if that makes sense. So in times of high inflation, and this will also come and go, by the way, it's not like we're going to be in shocking inflation for the rest of our lifetimes. In fact, dare I suggest that I'm no economist, but I suspect we're already starting to see the signs of that, particularly being led from the States, to perhaps softening. But it is a real issue. And when it comes to high inflation, you just for the periods that we're in it, you want to think about defensive strategies. And by defensive, I mean, how do you defend the value of your money in a time of rising inflation? And there's only so many options, right? So, you've got the bank, but that's a fairly clear miss. And then you've got, managed funds, and I would suggest over longer timeframes, very much they can return more than the inflation rate, as with property, depending on where the cycle is. So I would suggest that you don't view an investment strategy based on the current economic condition that you're sitting in. What you do is you look at the time frame you're working with, and it could be, the next, 10, 20, 25 years. You look at, like I said, future lifetime cash flows, just as you see them today. They don't have to be exact. And we look at what kind of return we need to try and meet your needs. And then you put a strategy in place. And quite frankly, I wouldn't change that strategy that I was looking at today, but given that we're in higher inflationary period than I would have probably 3 years ago, because it's a momentary part of the cycle. It's not going to be present in that whole plan. And we don't, the fundamentals of your plan, we don't, a good plan doesn't need to be radically altered as the economic winds blow. You know what I mean? Like, it's kind of been considered when you pull all those factors together. So first and foremost, I'd say don't panic. When you're looking at the longer picture, I get inflation's very present and scary, and it's all the media is talking about, but it won't be like that forever and shouldn't affect your long-term planning. But while you are in an inflationary period, I would suggest that shares are in fact one of your best defensive strategies. So if you've got a diversified portfolio, the share component will in fact be a more defensive strategy in that small snapshot of time. And it may not feel like it on the given day you're looking at it, but it will be. And Hannah, you're probably better positioned to talk about property, but I would have thought that would do okay as well.
Yeah, from a property perspective, I think the comment that was made was nothing really outperforms the 7% inflation. And I think that isn't true. And so I just need to put some context around that. So if you buy a property, let's say you had $100,000 and you could put that in the bank and you could get a 3% return, which definitely is well below the inflation, right? So you've pretty much burnt some of your money just by putting it in the bank. You could put it in a managed fund and maybe you'll get 7%. Nikki might get you more, but I'm not even going to promise that. But then you say, well, if I put it into property, well, I wouldn't buy a $100,000 property. I would buy a $500,000 property because I'm going to borrow money from the bank to do that. And so I'm getting a return on a $500,000 property despite only tying up $100,000 of my own money or equity. Well, that return is 300% greater than if I put that money in a managed fund without borrowing leverage or using leverage. And if I look at the return on my $100,000 invested, the return on that is, let's say the internal rate of return could be 20%, which certainly is significantly higher than inflation. But the thing, so I guess I disagree with the point that property can't outperform, is what I was trying to say there. But the thing that I think you are asking is, well, what mechanisms do we have available to go toe to toe with inflation? Because inflation is a pain. And what we know about inflation is it does two things very, very well. You just need to be in the right channel to take advantage of it. It pushes asset prices up, which we know. We saw that through COVID, but that's why Nikki's saying, well, let's weight ourselves more towards shares and asset price, because that's going to lift itself, because inflation lifts asset prices. It also pushes property prices up. But the beautiful thing about inflation is when you use bank debt, because that is a way of hedging inflation. So what I mean by that is if you had $100,000 and you put it in the bank and we've got inflation of 7%, that money now buys us $93,000 worth of value. Like we've lost $7,000 of value. Similarly, if we had a $100,000 mortgage, because the value of money has reduced by virtue of inflation, that mortgage is now worth $93,000. So inflation has a beautiful impact on lowering the value of debt. And I think that's one of the best things you can do when you're trying to tactically respond to inflation, is you double down on the debt and you double down on your growth strategy. But your overall strategy should be encompassing those things as well. It's just kind of satisfying to stick it to inflation with something, with another lever you can pull. I get that.
Hannah, someone wants to know if you still see clients if they were to make an appointment to plan their retirement.
Yes, but I can say that you'd be matched with a consultant that specializes in that retirement and wealth planning, because it's so nuanced. Whether you're working with myself or Nikki or one of our other senior coaches, it is, yeah, there's a lot to that.
Quite a few people asking about mixing their overseas pensions and also overseas annuities. Nikki, are they able to do that? I think there was one question from someone that said they've been back in New Zealand for 18 years, but would like to bring their overseas pension home now.
Yeah, absolutely. So yes, you can do that. It is quite a nuanced area in that, you know, it matters where the pension originated or the annuity originated. So every country has its own specific sort of rules and regs around their pensions, and those rules and regs follow it. So if you bring it across to New Zealand from the UK, for instance, you know, whatever the age of entitlement was in the UK, it's still the same when it hits New Zealand shores. It's not adjusted to what we do here, you know.
Not a get out of jail free, get out of your locked in fund.
Exactly, not on any level. So, and there's usually tax implications and stuff as well. So, but in most countries, and I'm not going to say all, but certainly most, you are certainly able, particularly when you've clearly lived somewhere else for so long, you know, move the pension over, and I would absolutely consider doing that so that you could consolidate your assets and get them optimized in the country where you live. I would also strongly recommend that people do it because you know, you are totally, that pension, wherever it's domiciled, is totally at the whim of that government. So I remember I got told this by a senior advisor many moons ago, and I remember thinking, oh, well, whatever, big deal. And I reckon within 2 or 3 weeks, the UK just suddenly said overnight, no warning, that they would no longer transfer pensions to people that had now, you know, gone to live somewhere else. And that was it, you know, no negotiation, that's it. And I couldn't believe my eyes, and his words rang in my ears. And I was like, so what he's saying is it's introducing another element of risk, you know, from a country that's being governed outside of where you live. So I would I would advise getting advice on that though, because you know, particularly for annuities, but but I think you should get the right advice. Absolutely, you can bring them over, and I actually think if this is where you are to stay, then you should do that and optimize that money.
Actually, on that note, Hannah, Emma would like to know whether Enable Me's retirement planning can take into consideration advice on foreign property and pensions.
At a high level, absolutely. I can also tell you at a high level what I generally think about foreign properties, which is the tax implications are hidden and horrific, because you've got movements in exchange rate that create unrealized movement, like kind of fake gains or fake losses, but you are forced to pay tax on the gains that the property hasn't necessarily increased in value, just the exchange rate has changed, and now you've got to pay tax on it, which I hate. I hate that you can't leverage or get it working for you harder. And I usually hate that there's capital gains attached to that property. Now, there can be genuine reasons why it still makes sense to keep that property, but when we're looking at it, when we're looking down the barrel of retirement, we ask your permission as to what's on the table for what we can kind of work with. And if an overseas property and overseas pension is part of the things that you want us to consider, then hang on to your hat, baby.
I'm conscious we are fast running out of time, so let's squeeze in a few more questions. Nikki, there's someone here who's got money in silver and gold, and they want to know, are managed funds a better option?
They're certainly more liquid, but
listen, silver and gold, they are, you know, they are perfectly valid investment options, if you like, but they bring something different to the table. But again, I'm biased, but I think that you should have your serious planning. This is my serious, I'm going to live the retirement I want. I've got some, you know, relative certainty around this plan working because we've really pushed it around and structured it the way it should do. And then I think if you're interested in other types of investments, and in that camp, I would not because I think I don't judge them all the same, but silver and gold for me would be very much a side play. As you know, and if you're really into digital currency, that would be a side play, or even stock picking because it's fun. You know what I mean? So, you know, there's nothing wrong with those activities, and there's a lot of learning that can come out of it, and some wins. But I would put that in a separate bucket to my, this is my most serious, this is what's going to drive my life when I no longer want to work. That
we want to know that you're sorted first before we maybe go into more speculative or other areas. Yeah, you'd hate to have put your entire retirement savings on Bitcoin in the past 12 months, wouldn't you?
Well, there was probably a day in the last 12 months where you were really happy, but if you didn't cash in, then you probably would regret it. And I'd probably add to that, art is another example of a legitimate investment, but not something you can necessarily liquefy or you get access to really quickly. And it's the market of the person who's involved, who wants your art, as I say to my husband, is very different than perhaps your own taste. But
I just want to clarify, Hannah's not talking about liquefying her husband's art in a blender.
And my husband's an artist.
Yes, what we mean by that is just you're able to access the money. You can't tear off a piece of the painting and hock that off. You'd have to find a buyer for the whole piece or the whole collection.
Yeah, the whole collection, unless we're desperate, and we will dismantle bits if we need.
Nikki, Douglas would like to know, and this might be a hard one to answer in typical terms, but he'd like to know what a typical asset base looks like at retirement after a successful financial plan. How would it be set up to be used for retirement? Can you talk in generalities there?
Yeah, so that's actually the easy part, to be perfectly honest, because everything would have been constructed on the way in. So you may have been accumulating into this plan, or it might have been that it just got put together just at the point of retirement. It doesn't really matter. And we would have considered all the things we've touched on tonight. So there may have been a role for property still in that situation, and managed funds. We would have liquidity considered, so there might be some cash at bank and managed funds. And we would have looked at that we look at that whole plan together, but we would have known before, like the get-go, that say if your cost of living was, $100,000 a year less super, we would have broken that down into like a monthly amount or a fortnightly amount. That would have been that gets transferred, from your managed fund to your bank account at whatever frequency you like. So that's you getting on with living your life. If there's property and, other funds, still sitting in those managed funds, they carry on working while you do that. So you sort of set everything up and then you just have a flow going on. It's much like you're paying yourself, like you used to get paid by somebody else.
I like that. I like the idea of that, just from a mindset perspective, that even though it's my own money coming from one place to another, that it's topping me up, fortnightly or however you structure your finances. I like that.
It does help the mindset. And just one last point on that is that you can do it comfortably, because we would have considered like how long, like before that whole thing was set up, how long that would last, if that makes sense. And so you'll be informed with that information, and you can make adjustments depending on whether you like the outcome or not, but you will know what that outcome is likely to be. And that's because the planning happened first.
Time for 2 more questions, one for each of you. Hannah, a question from Kim. We've got 8 rental properties in New Zealand and 7 in the US, very close to retirement. Should we look to sell the overseas properties? Not right now, the exchange rate's not good. I think the New Zealand property is about 9 million, maybe US about 500,000, debt of 2 million. So that was the context. It's all a bit confusing, but the central piece of that question is, should we be selling the overseas properties?
Yeah, when you said you've got 8, and I thought you were about to say 8 children, but 8 properties I can definitely cope with. Well, I think from the exchange perspective, that the exchange rate doesn't impact whether you should be selling the properties overseas now. The market overseas should be what dictates that. Whether you then convert that into New Zealand dollars now is what the exchange piece is. As soon as Nadine said US, I was just like, oh no, the tax implications for this are crazy, because they're going to tax every angle they can, right? But my tendency is to get in, get it done, simplify, and let's work with what we've got and get clear on what our options are. I don't tend to like things being spread across jurisdictions unless you're going to be moving to one of those jurisdictions during your retirement and moving permanently rather than visiting for a prolonged period of time. So I can't comment on what's happening in the US property market, but generally the rule is, can we simplify this so you are in control of what is sort of feeling quite larger than what it needs to feel, when we should be trying to optimize what we've got.
Nikki, is there a reason you recommended managed funds rather than index-based funds? Is one better than the other, perhaps at different times of your life?
That's a good question. I think in my mind, and this is very much opinion, because I'm sure, if anyone has researched this ever on Captain Google, there's a million opinions on this. But the way I see it is, I think an index tracker, which is like a market-wide investment in any particular index of your choosing, is likely to outperform individual stock picking. I know we all think we can do better than that, but the reality is, and research would more than suggest, that we're not very good at that. So, I would go, if I was to rank them, individual stock picking would be bottom. Exchange traded funds would be better than that, because there's just statistical evidence that suggests they outperform. And then you've got managed funds. And now managed funds is a big term, like it's a big term. We say it like it means one thing, but it means multiple things. In my opinion, I like a managed fund that is really only one step up from what you would consider an exchange traded fund. So it's got a management light touch on it. It's called a tilt, right? And because markets perform pretty well, and ETFs can be low cost, but with a slight light management touch on it, they can insulate you just a little bit from just riding the market unguided, or just, you know, as it happens. I'm trying to think of the right words, but you know what I'm saying. So there are people out there that will, you know, swear blind ETFs or nothing, you know, and other people that'll go managed funds or nothing. I think both are good, to be perfectly honest. I don't think whether one is good, whether an ETF or a managed fund is better, I don't see as particularly related to your age. So it's just a preference thing. And for my money, I like something right in the middle. So just up from ETF, but not to the full, you know, the really fully managed funds where you've got lots of guys in really expensive suits,
big salaries,
deciding, like, you know, like proving that they're better than the market, you know, and sometimes they have their good days and sometimes they're really not. So I prefer to come to the, you know, the lighter touch end.
Well, look, if this has been such a fascinating discussion, and it's such, as Hannah said, such an important financial milestone, if this has raised some questions for you, or that you've realized that you need to have a plan, you need to know that you're on track to have enough, you need to know that plan is still fit for purpose, whether inflation is low or high or otherwise, and that you can navigate the stages of retirement, all of that we can help you with, whether it's Hannah or one of our other advisors, or Nikki as our investment specialist. It starts with an initial consultation. So we've got an offer on the screen there now for you, which you can access by either heading to the website or scanning the QR code that's on the screen now. And we'll discount that for you because you've taken the time out tonight to talk to us and listen to us. So you can get that for $150 plus GST instead of $350 plus GST. You just need to have booked that by this Friday, the 19th of August. And we also have some other money chats in our series that if you would like to come along to, you may benefit from. So we've got one on paid parental leave, maybe if that's not you, but a member of your family that might be in that situation. But also what might be of interest is the ins and outs of intergenerational wealth. Because if you're thinking about retirement, you might also be thinking about you want to help your kids or your grandkids or leave a legacy. And there are a few things, lots of things to be considering when it comes to intergenerational wealth. So please do take advantage of the offer if you're in need of preparing for your retirement years, because ultimately we want them to be good years, not stressful years. And Hannah, myself, all the other advisors at Enable Me, we pride ourselves on being able to smooth that journey. So thank you for your time tonight. Thank you so much, Nikki and Hannah. As I promised, they're fantastic sources of information. So have a wonderful evening.
Thanks, Nadine.